Hello, welcome back to class. And we'll be talking about comparative tax system. And here we'll look into some countries. We compare some countries' tax system with each other. And we'll look at tax system in developed countries, having focusing on USA, UK, and the Canada and the European Union. We look at emerging markets like Russia, China, Brazil, India, Australia, and then we look at developing countries like Nigeria, Ghana, South Africa, Kenya, the United Arab Emirates, and we make a comparative analysis of the tax system, the rate, tax law, the rate, and the compliance system, and lastly, the tax reform and administrative efficiency across these nations. Why do we have to do this in comparing tax system? It actually helps to be able to understand how different countries design their tax system based on their unique economic, political, and social context. And the key question that have been asked is, how do tax structure differ between developed, emerging, and developing economies? What are the trade-off between efficiency, equity, and simplicity? And lastly, how does administrative capacity shape a country's tax system? These are the questions we need to actually find answers to. And looking at the relevance, it's essential for advising multinational corporations, informing policy, and also understanding global economic trends. For developed economies, it is characterized by high tax to GDP ratio of maybe between 25 to 45%, with sophisticated administration, multiple revenue source, a complex welfare state. And looking at the United States, it actually makes use of the federal system, where it's actually a complex layer comprising of federal, state, and local, and it is heavily reliant on income and payroll taxes and no federal VAT. For the United Kingdom, it's a unitary system that is a centralized administration, the HMRC, and key taxes are the progressive income tax, national insurance, and 20% value-added tax. For European Union, it's an harmonized VAT, a minimum 15% standard rate, national variation. And in terms of national variation, it's actually diverse corporate tax system. For Ireland now, 12.5%, for Germany, 30%. And that's how it varies across region. For emerging markets, this is characterized by modernizing system, growing tax base, balancing development needs with revenue generation. An example of this is China, and it offers a centralized control where major reform is being carried out on VAT, individual income tax, and key feature is that there are 25% corporate tax, 13% VAT, heavy investment in digital administration in terms of golden tax system. And for India, it's experiencing landmark reform, the 2017 goods and service tax, unified multiple central or state taxes. And it's actually complex because it has a multiple GST rates like 5%, 12%, 18%, and 28%. And for Brazil, it's actually a notorious complexity and over 90 different taxes, and they are heavily burdened. There are high compliance cost and cascading consumption taxes as such. And for developing country, They are characterized by low tax to GDP ratio, large informal sector, reliance on indirect taxes and natural resources. And the example of this is Nigeria, which is dependent on oil and more dependent on oil for source of income, and now it's actually still trying to change. So, and historically, it relies on petroleum profit, and key taxes include the 30% corporate tax, 7.5% VAT on VAT, and personal income tax administered by states. And the challenge is it's very low tax to GDP ratio of about approximately 6%. And for South Africa, it's Africa's most advanced system with sophisticated and efficient system. And its future is progressive income tax up to 45%, 27% corporate tax, and 15% VAT. And for United Arab Emirates, there is a recent shift from zero tax to introducing 5% VAT in 2020 and 2018 and 9% corporate tax in 2023. And there is no personal income tax. In comparing this, we see that there is a gradual reduction due to tax competition and in global trends. And as per the rates spectrum, the low tax jurisdiction in terms of the United Arab Emirates with 9% and Ireland with 12.5%. And the middle range like the USA 21% and UK 25%, China 25%. And we have the higher rate in terms of India having 34%, Brazil 34%, and Nigeria 30%. And small business rates, many countries offer reduced rates to support small and medium scale enterprise. For example, Canada 9% and UK 19% on small and medium scale enterprise. And looking at the on value added tax, it's the global norms is an adoption by over 170 countries, and the US is a major exception rather. And the standard rates range from low United Arab Emirates 5%, Canada 5%, Nigeria 7.5%. We have the medium, the likes of South Africa having 15%, Kenya 16%, UK 20% on VAT, and high like Hungary having 27% on VAT. Key features include multiple rates for essential, zero rating for export, and registration threshold for small business. Looking at the personal income tax, we look in terms of progressivity versus simplicity. And highly progressive include Sweden, Denmark, South Africa. We have the moderate progressive in terms of USA, Australia, UK, and we have flat or near flat in terms of Russia and Bulgaria. And for developing world challenge, progressive statutory rates are often undermined by narrow tax bases and large informal sectors. The engine room is the tax administration and compliance, and what separates effective system is actually the digitalization and in terms of e-filing, the pre-filled returns, the data analytics, which from UK making tax digital for Australia, that's Australia's ATO. And another one is risk-based auditing, which is targeting resources efficiently. Another is strong withholding mechanism. And the last is taxpayers services. And for developing country, they focus on using technology to leapfrog challenges. For example, Kenya's integration with M-Pesa, Pesa mobile money. And lastly, the global reform trends. And for this, we see tackling the digital economy with digital services tax in terms of unilateral versus OECD Pillar 1, which is multilateral. Another is curbing multinational avoidance, and is another global reform trend. And then we also have the environmental taxation, talking about the carbon taxes to address climate changes. This is also coming up now with global reform. And then we have the base broadening and simplification. And this is a constant challenge, especially in complex systems like Brazil. In conclusion, no one size fits all. As tax system reflects a country's unique context of administrative capacity, and simplicity is actually the strength, and then technology is transformative, and also international cooperation is deepening as and the successful tax reform requires adapting global principle to local reality.